In the early 17th century, a simple flower brought one of the world's most advanced economies to its knees. Long before stock markets, cryptocurrencies, or housing bubbles, there was Tulip Mania, the first recorded speculative bubble in human history. It was a time when a single tulip bulb could cost more than a luxurious house, when ordinary people believed riches were guaranteed, and when logic quietly disappeared beneath collective greed. Tulip Mania did not begin as madness. It began with beauty, rarity, and desire. Tulips were exotic, colorful, and unlike anything Europe had seen before. What started as admiration slowly transformed into obsession. Prices rose, fortunes were made overnight, and society became intoxicated by the promise of effortless wealth. But beneath the surface, something dangerous was growing. The value of tulips became detached from reality. People were no longer buying flowers, they were buying dreams. And like all dreams built on illusion, it would eventually collapse. Tulip Mania teaches us a timeless lesson. When belief replaces value, collapse becomes inevitable. This is the story of how the world's first financial bubble was born and how it burst. To understand Tulip Mania, we must first understand the Dutch Republic in the early 1600s. This was one of the wealthiest and most advanced societies on Earth. Trade flourished, ships sailed across the globe, and Amsterdam became the financial center of Europe. The Dutch middle class was growing rapidly, and for the first time in history, ordinary citizens had disposable income. Banking systems were developing, credit was accessible, and commerce was deeply embedded in daily life. Wealth was no longer limited to royalty or nobility. Merchants, craftsmen, and traders were becoming rich, and with wealth came ambition. In such an environment, speculation thrived. People sought new ways to multiply money quickly. Exotic goods, rare items, and overseas trade captured public imagination. The Dutch were not reckless by nature, but they were confident. And confidence, when unchecked, often turns into overconfidence. Tulips arrived in Europe from the Ottoman Empire as luxury items. They were rare, difficult to grow, and visually stunning. Soon, owning tulips became a symbol of status and refinement. What had once been a gardener's curiosity became a cultural obsession. The stage was set. Wealth, optimism, and novelty combined to create the perfect conditions for speculation. At first, tulips were grown and traded by botanists and collectors. Certain varieties, especially those with unique color patterns caused by a virus, became highly prized. These broken tulips were rare and unpredictable, making them even more valuable. Soon, demand outpaced supply. Prices rose steadily, attracting attention beyond the wealthy elite. Merchants, artisans, and even farmers began trading tulip bulbs. What was once a hobby transformed into a marketplace. The most dangerous shift occurred when people stopped buying tulips to grow them and started buying them to sell at higher prices. Tulip bulbs became speculative assets. Contracts were traded months before bulbs were even harvested. People bought on credit, betting on future price increases. Markets formed in taverns and public halls. Prices were shouted, deals were sealed with handshakes, and fortunes changed hands in hours. The belief that prices would always rise became widespread. Anyone who questioned this belief was ignored or mocked. Tulips were no longer flowers. They were money. And like all speculative assets, their value depended entirely on confidence. Once that confidence cracked, everything would collapse. As tulip mania intensified, the tulip market underwent a dangerous transformation, one that would later repeat itself in every major financial bubble in history. People stopped trading real tulip bulbs and began trading promises. Contracts were created that allowed buyers to purchase tulips months in advance, often before the bulbs had even been lifted from the ground. This was the birth of one of the earliest forms of futures trading. These contracts allowed speculation to explode. A person no longer needed to own land, grow tulips, or even see the flower to make money. All they needed was belief, that someone else would pay more tomorrow. Paper agreements replaced physical assets. Wealth became abstract, fragile, and disconnected from reality. Taverns became trading floors. Deals were made over drinks, laughter, and loud bargaining. Many traders had no understanding of tulip cultivation or market fundamentals. They were driven by stories of neighbors getting rich overnight. Fear of missing out spread rapidly, infecting every layer of society. Credit fueled the madness. People borrowed money to buy contracts, assuming profits would cover debts. No one imagined prices could fall. After all, they never had before. Confidence became absolute, and that absolute confidence would soon become the market's greatest weakness. Tulip Mania was no longer about flowers. It was about belief, leverage, and speculation. And history shows us that when markets are driven by belief alone, collapse is only a matter of time. By the mid-1630s, tulip prices had reached levels that defied logic. Certain rare bulbs, such as the famous Semper Augustus, were sold for prices equivalent to large canal houses in Amsterdam. A single tulip bulb could cost more than 10 years of a skilled worker's wages. Livestock, land, furniture, and savings were exchanged for flowers that bloomed only a few weeks a year. The market became detached from economic reality. Price increases accelerated rapidly, not because of scarcity alone, but because of speculation. Buyers believed prices would double or triple within weeks. Sellers felt regret for selling too early. Greed replaced caution entirely. Even those who sensed danger stayed silent. Selling meant missing out on future gains. Holding meant risking everything, but risk felt invisible in an environment of constant price increases. Rational thinking was drowned out by crowd psychology. This phase of Tulip Mania reveals a crucial pattern seen in every bubble. Prices rise fastest at the moment value matters least. When people stop asking, "What is this worth?" and start asking, "How much higher can it go?" the market has already crossed the point of no return. Tulips had become symbols of status, intelligence, and success. Owning one meant you were ahead of the crowd. Losing faith meant social exclusion. And so the madness continued right up until the moment it didn't. One of the most important and dangerous moments in any speculative bubble is when ordinary people become convinced that riches are guaranteed. During Tulip Mania, this moment arrived when the tulip trade moved beyond wealthy merchants and collectors and entered the lives of craftsmen, farmers, sailors, and shopkeepers. People who had never participated in speculative markets suddenly believed they had found a path to easy wealth. Stories spread rapidly through Dutch towns and villages. Neighbors talked about buying a tulip contract in the morning and selling it for profit by evening. Taverns became centers of financial gossip, where success stories were repeated again and again, while failures were quietly ignored. The belief that tulips were a sure thing became part of everyday conversation. Many sold personal possessions to participate. Furniture, livestock, tools, and savings were exchanged for contracts written on scraps of paper. Few understood the risks. Even fewer asked what would happen if prices stopped rising. Why would they? The market had only gone up. This phase of Tulip Mania reveals a powerful psychological truth. When speculation becomes social, logic disappears. Participation itself became proof that the system was safe. Anyone who refused to join was labeled foolish or overly cautious. The fear of missing out became stronger than the fear of loss. The bubble had reached its most unstable stage. Once ordinary people enter en masse, the system becomes extremely fragile because it depends entirely on continued belief. And belief, unlike value, can vanish instantly. In early 1637, something extraordinary happened. At a routine tulip auction, buyers failed to appear. Contracts that had been eagerly traded just days earlier suddenly found no bidders. Confusion turned into panic. Traders waited, assuming the pause was temporary. It was not. Within days, prices collapsed. Buyers vanished. Sellers rushed to exit, only to discover that there was no market left. Contracts became worthless almost overnight. The confidence that had driven prices upward disappeared just as quickly as it had appeared. Unlike modern financial markets, there were no formal exchanges, no central banks, and no safety nets. Contracts were often informal agreements made in taverns, unenforceable under law. When prices collapsed, many simply refused to pay. Lawsuits followed, but courts were unwilling to enforce speculative contracts tied to gambling-like behavior. The collapse was psychological as much as financial. Once belief vanished, the entire system ceased to function. Tulip Mania did not slowly unwind, it snapped. This moment illustrates one of the most brutal realities of speculative bubbles. Markets do not collapse when prices are high. They collapse when confidence breaks. And when confidence breaks, recovery is impossible. When Tulip Mania collapsed, the damage was not limited to lost money. It shook the social fabric of the Dutch Republic. Fortunes that had been built on paper vanished in days. Families that had believed themselves wealthy suddenly faced debt, humiliation, and uncertainty. Trust between buyers and sellers collapsed along with prices. However, unlike later financial crises, the Dutch economy itself did not completely fall apart. Trade continued, ships sailed, and commerce survived. The real damage was psychological and social. Speculators who had borrowed heavily were ruined. Relationships were destroyed as contracts were broken and accusations flew. The belief that markets were rational and predictable was permanently damaged. The government attempted to intervene by allowing contracts to be canceled for a small penalty. This decision reduced chaos, but also confirmed an uncomfortable truth. Much of Tulip Mania had been little more than legalized gambling. The state refused to fully enforce speculative debts, signaling that society recognized the bubble for what it truly was. Tulip Mania left behind a society that was more cautious, more skeptical, and deeply aware of how quickly collective madness could take hold. Wealth built without substance had proven to be fragile. The collapse did not destroy the Dutch Golden Age, but it left a scar that history would never forget. Over time, Tulip Mania became a symbol of irrational speculation, but historians continue to debate its true scale. Some argue that only a small portion of society participated, and that the economic damage was limited. Others believe the psychological impact was far greater than the financial losses themselves. What is undeniable is that Tulip Mania represents the first recorded example of mass speculative psychology. Whether prices were exaggerated or not, the behavior was real. People believed prices would rise forever. People ignored risk. People followed the crowd. Later bubbles, the South Sea bubble, the Mississippi bubble, the dot-com crash, the 2008 financial crisis, and even cryptocurrency booms followed the same pattern. Different assets, same psychology. Tulip Mania became powerful not because of its scale, but because of what it revealed about human nature. It showed that speculation does not require modern technology, complex algorithms, or global markets. All it requires is belief. History remembers Tulip Mania not as a failure of economics, but Tulip Mania offers lessons that are as relevant today as they were in the 17th century. The first lesson is simple, but often ignored. Price is not value. When assets rise only because people expect them to rise further, collapse is inevitable. The second lesson is psychological. Humans are social creatures. We follow crowds, trust stories more than data, and fear missing out more than losing money. Bubbles thrive on emotion, not logic. The third lesson is structural. Markets need rules, transparency, and accountability. When speculation replaces purpose, systems become unstable. Whether it is tulips, stocks, real estate, or digital assets, the pattern remains the same. Tulip Mania reminds us that history does not repeat itself, but human behavior does. Every generation believes it has discovered a new path to effortless wealth, and every generation eventually learns the same painful lesson. In the end, Tulip Mania was not about flowers. It was about belief, greed, fear, and the timeless weakness of human judgment. As a failure of judgment,